Okay, hi everybody, and welcome to the Introduction to Futures Trading webinar. My name is Brett Manning. You see me on the site as ChartTrader. I'm under the Chart ticker and the ETFXX ticker. Okay, we're going to be covering a lot today. I'm going to go fast over some of this material, particularly the stuff that I know that you can brush up on without me. The tickers, expirations, the mechanics. We'll breeze through them. We'll go quickly, so just kind of try to stay with it and know that you can go back. And most of this is rote learning stuff. You can soak it up easily with just a search browser and an internet connection. So I think it's more important that I spend more time toward the bottom of this on what I've learned over 15 years of doing this, and go through some of what I think are the most important characteristics and strategic and tactical considerations when you're trading something as leveraged as the futures market. Okay, and now we come to the subject of why I trade the futures market, and the best I can do is put it like this. First of all, futures are necessarily a top-down macro view on the world, and I guess I think in terms of, and I've always kind of thought in terms of mastering a handful of markets and hypothesizing about really big picture issues. So understanding really deeply a smaller number of things, and I've never worried as much about trying to understand the fate of an individual company. It's never been quite as interesting to me, and I think that this is kind of like left-handedness and right-handedness, really, among traders. I think you're going to figure out you're either one or the other. You're interested in scanning to try to find that great growth stock, or you're interested in trying to figure out whether you're in an inflationary or deflationary situation, or a bull market or a bear market in the commodities complex, or something like that. I'm definitely interested in the latter, and if you've signed up for this webinar, you may be kind of in the same situation. And that gives us really two different choices for as far as vehicles, and those are futures and ETFs. And here's basically the breakdown. Futures have a lot of advantages over ETFs. The commissions are cheaper pretty much across the board. Futures have less slippage in almost all cases, and you can look into that. You'll find that it's true. Futures trade 24 hours per day. That means that stops work on major overnight moves. That also means that you've got interesting things that can unfold at night that you can take advantage of, whereas ETFs obviously just trade basically during the regular trading hours of the stock market. And futures are also leveraged much more than even the most leveraged ETF, so it's really a bit like comparing a handsaw to a power saw. And this is an analogy I'm going to come back to a few times, because that obviously poses some both good and bad issues. And now, just a note about how I watch the market. Because I'm approaching things from this top-down standpoint, I really want to encourage you to, even if you just want to trade S&P futures, it's really good to expand your horizons as far as context and watch the S&P futures market in the context of the commodity complex, currency markets, rate markets, because you'll come to understand that there's a lot of correlations there. And really what you're talking about is a financial universe. And if you just try to watch one aspect of that universe and try to figure out that aspect of that universe, it's kind of like, I guess it's a bit like looking through like a special pair of glasses that only shows you the aspect of the world that's the color blue. You can analyze that world and everything that's blue and only blue and try to make sense of it and predict what next is going to happen in this blue slice of the world. But the sense you make is going to be unreliable, and it's going to be nonsense until you can include the rest of the visible spectrum. And that's kind of, I think, like just watching the stock market. Even if you want to just trade the stock market, you should get a feel for commodity markets and currency markets and rate markets. And with futures, you can not only get a feel for that, but you can also extend over and trade these other markets. From there, I'd like to go briefly into kind of what futures markets are, why they exist, and how this really got started, so that gives us a little bit of historical context. All right, these originated as what are known as forward contracts for hedging commodities all the way back several thousand years. And, really the purpose is to be able to control input costs so that you can plan out a business when you need to invest. And the really simple example of this would be the airline industry with jet fuel costs. If you have jet fuel costs, jet fuel is extremely correlated with the crude oil. And if you get a spike in crude oil prices, you're going to get a spike in jet fuel. And if you come into the quarter trying to plan out how you're going to manage a business like American Airlines, and you don't have any ability to lock in what your costs are going to be on jet fuel, which who knows what's going to happen. There could be a major escalation of tensions in the Middle East, and to the extent that it actually starts either getting wells on fire or causing a lack of access to a major oil field. And if that's the case, you're going to see a major spike in crude oil prices and jet fuel as well. And if you haven't been able to control for that, and you're running a major corporation like American Airlines, and your input in terms of your fuel costs suddenly spikes through the roof, it's going to cause enormous problems. And so that's what the futures markets are really for. It's commercially being able to control input costs, because they've got traders in that type of situation who are levered up long in the crude oil market to hedge that exposure. So if there's a major spike in crude oil prices, the jet fuel costs are offset by their gains in their crude oil contracts. And there are a number of other examples of this. The auto manufacturers with how they deal with copper, iron, and aluminum, and the food processing companies in terms of their grain inputs. So this kind of gives a sense of what this is really about. But of course, in the 1980s, this spread into a really interesting shift in the situation. Portfolio managers who hold a basket of stocks realize that they're exposed to market risk, and shorting S&P futures is a hedge for that risk. So the index futures markets really kind of came into being as a means of providing the same type of control that the airline had in terms of its input costs for the market risk held by major mutual funds. And obviously, if you apply this concept to group herding dynamics and crowd psychology, you get a feedback loop of self-reinforcing selling. And of course, that's exactly what we got on Black Monday in 1987, when the Dow Jones Industrial Average fell all of 23% in one day. After that, we set some new rules and then went on to add some other interesting futures markets for rates, currencies, and commodities, and even weather. And at this point, that leaves us with a big menu if you're a futures trader, and a lot of things that you can take advantage of, and a lot of situations that you're going to be able to profit from if you gain the range of experience. Now, here's a list of really good liquid futures markets that I regularly participate in, and it's a good kind of control menu. The S&P, the NAS, the Dow. The Nikkei actually has an excellent contract on the CME. And in the commodity complex, you've got the metals, gold, silver, and copper, and the energies, crude oil and nat gas. I really don't mess around in the soft stuff because it's just not very liquid, and that's important to me in terms of how I conduct my own order flow. I don't like to just jump into something that I may not be able to get out of at a moment's notice. Currency markets, the euro, the yen, the Aussie, the pound, the loonie, and the Swissy. The loonie is the Canadian dollar. Fixed income, I pretty much just stick to the 10-year and the 30-year. And there's a list of the things that I trade the most. Okay, now let's move into some of the more mechanical aspects of this. And again, we're going to go over Symbology, briefly over expirations and rolling, some points on brokers, and some points on the ways to understand these markets in terms of price and dollars and ticks. But I don't want to spend a tremendous amount of time on this section, because these are really things that you can just go and learn on your own. And I don't see a whole lot of value add in me just kind of reciting it. But we'll touch on each of the concepts that I can tell you it's important that you do know before you just start to barrel into the futures markets. And then you can understand, if you're new to this, which topics you need to look into further so that you really have a really strong grasp of this stuff. So first of all, in terms of the Symbology, futures ticker, it's made of the root, the month, and the year. And that's going to be a unique identifier for each contract. And a good way to think about this is, it's really the contract that's a market. So, for instance, right now we're trading the December contract for the S&P futures. And that full ticker is ESZ4, with the ES being the root of the symbol, the Z being the identifier for the month of December, which is when this contract expires, and the year being 2014, which is denoted by the number 4. Some interfaces you put in the last 2 digits of the year, so it would be ESZ14. But either way, I guess it's good to just look at this as that's a market. And ES, we just expired ESU4, right? That was the September expiration just a couple weeks ago, actually last week. And that was a separate market. This is a market of its own. That was a market of its own. And the two of them happen at different prices and trade at the same time. So before we expired the September contract, September and December were both trading. And they were trading simultaneously and at different prices. Each one was its own market. And the S&P is the I guess what's tantamount to the commodity. Whereas the Each contract is really the market. And if you think about it that way, it'll give you a handle on when you shift from one market to another. With the S&P, it's really, you can think of it as just one market and just look at the continuous contract and not really worry about it. But if you start moving into crude oil or natural gas or silver or copper or these other markets, there can be quite a difference in price, and you really do need to look at them as separate markets, and you roll from one to the next. And that's the next topic, which is expirations and rolling. And as I said, each one's a separate market, and each one expires and gives rise to the next contract, which takes the volume in. The contracts further out on what's called the forward curve are trading all along, but the volume kicks up tremendously when it becomes what's known as the front month. And so each time you get one rolling off, it rolls its volume a little bit before its actual expirations. It rolls the volume off into the next contract. Just think about it like a herd of traders are migrating from one contract to the next, and they jump across pretty much all at the same time because most traders don't want to trade the less liquid contract. So that becomes the front month. The other one then expires shortly after, and we move on. And all of these markets actually, as I said, happen at slightly different prices, but they trade at the same time. So what's interesting to do is what's called the forward curve gives you a sense of how these markets line up through time in terms of their expirations and their pricing. So it's interesting to just think about that forward curve and to understand if, for instance, each successive contract is trading at a lower price as you go out into the future. And that's something called backwardation. And if each contract is trading at a successively higher price going into the future, that's called contango. And it says different things about a market. For instance, in crude oil, I've noticed that when you have a real uptrend in place that's happening on major expansion of demand, you tend to have backwardation in the forward curve, like we did, for instance, in 2005, 2006, 2007, just a constant state of big backwardation. We've had a lot of contango since then, which shows you that it's a slightly different situation during the uptrend that we've seen now. As it also says here, different markets have different schedules of expiration. Some of them are quarterly, like the S&P. Some of them are bi-monthly, like gold, which is bi-monthly for the first half of the year, and then gets into the December contract, usually sometime in late August, and trades that all the way through the rest of the year. But each one, again, this is something you're just going to have to look into. For the markets that you're going to be interested in trading, just take the time, do your homework, learn the ins and outs of each one, the schedule of expirations, and what you should expect in terms of the forward curve, and obviously how to define the ticker, and just kind of make sure that you do the homework before you start trading it so that there's nothing that's a big surprise to you and you realize there's something that you don't understand or can't deal with or don't know how to do when you've got a situation where the market's moving dramatically and you've got positions established. That's a bad situation. Now, as far as a futures broker, there are a few things to consider, but they're not necessarily quite as easy to disentangle, I think, as a lot of traders generally think, at least in my opinion. I mean, pricing is obviously really important, but it's not the only thing. I use interactive brokers, and there are certainly specialized futures platforms that regularly give better prices than that, even though interactive brokers is really competitive. But there are specialized futures-only platforms that cut special deals. However, you can also get, you want to talk to your broker, whoever it is. If you trade large enough, if you're coming into this with a lot of capital, then you can obtain a special pricing deal as well as I have. And that's something to consider. However, I think that what people don't consider maybe quite as much is it's not just having the most bells and whistles, but the interface is really important. It's something, as long as it's something that you're really comfortable with, because in the heat of the moment, you want this thing to be an extension of you rather than something that you have to deal with. You want to be able to move. You want to have an idea, see a market, be able to act on a setup without having to go through a tremendous mechanical exercise. And different people feel comfortable with different things, and I think that start with something that has plenty of features but isn't so complicated that you can't easily interface with it, and consider that to be every bit as important as pricing, because at the end of the day, commissions are going to be a cost that are always going to be there, but if you end up feeling uncomfortable with the way that you interface and transact in a market, it's going to have a much greater deleterious effect than the commission costs. So just consider that as a balanced issue. And lastly, as far as quality of executions, in my experience, people I've talked to and systems I've used, as long as you're something that's remotely a professional platform, you're not going to see a whole lot of difference in terms of executions. Okay, so next up, I want to cover just the idea of looking at markets in terms of ticks and dollars. It's good to just distill all futures down to the uniform, smallest possible unit, which is the tick. And for crude oil, it's just like stocks in terms of being 1 penny per tick. Gold is 10 cents a tick. Silver's a half cent a tick. S&P's, NASDAQ is a quarter per tick. But that's not really the most important piece of information. The more important thing is to understand what that tick means in terms of money per contract that you put at risk when you define a setup and you decide where your stop needs to be to give it enough room. Now, I would really advise you to look at the process of determining your size, not as something where you just think, okay, this is the S&P, I'm going to trade 20 contracts or whatever it is, or 5 contracts or 2 contracts or whatever feels right to you. I don't trade the number of contracts that you just typically trade for that. First, understand what you're willing to risk on the trade, not just in terms of dollars, but what sort of move. In other words, if you have an idea about what you think is going to happen here, what sort of move would give you the sense that you're wrong, right? And that's where you're going to put your stop. If it does that, then I'm bailing. I'm not going to hang with this anymore if it moves such and such, right? So that's the most important thing to understand. And when you understand that, you can see how many ticks that is, and then from there, you understand how many contracts you should be playing, because in the end, assume it's going to go wrong and you're going to lose, and then understand as you put the trade on that the amount that you will lose if you are wrong is something that you're comfortable with, you're okay with. It's worth it for this setup to lose this much if it's wrong. So in other words, you look at the setup, you understand what move needs to happen to prove you wrong, you know that's where you need to put your stop, and you're able to instantly look at that market and figure out how many contracts you should put on based on how many ticks that move represents and your understanding of what the cost per contract per tick is in that market. And that's just a quick little arithmetic to get down so that it's second nature. You never have to think about it. In a fast-moving market, you can look instantly and make that assessment. And you'll get it. You'll get it down with a little experience, but you want to start from the fundamentals of understanding a market in terms of the cost per tick per contract, and be able to look at a chart on a particular time frame and understand basically how many contracts that implies you're willing to put on. Get really fast at that. It's an important thing to do. Okay, now so your job is to understand the things that we've gone over, as well as this one point here that's at the top, that are basically the mechanical, rote-learned aspects that are necessary before you really get involved in futures trading, and to review this, and then we can move on to some of the lessons that I've learned over time in terms of strategic or tactical issues. And as for the first point here, most of you probably know that because of the leverage involved in the futures markets, there are requirements for margin. In other words, how much capital you have to have in your account per contract that you have in play as a position. And the amount of margin necessary to stay in the position is different for intraday and overnight considerations, where intraday it's a little bit less than it is to hold overnight. So people generally end up with larger positions. People with small accounts or limited capital end up with larger positions during the day than they do overnight. If you have a small amount of capital to start out at this, then this will be an important consideration for you. But if you have a large amount of capital, and this is an important consideration for you, then I would encourage you to re-examine your approach, because that's insane. You don't need to lever up so much with these instruments that you can slaughter yourself when you've already built up a nice king's ransom. There's no need to get that kind of leverage in play to make a tremendous amount trading futures. But if you've got an account, say, under $20,000, then you're really going to constantly be aware of this set of requirements. If you've got some strong feelings about some markets and you want to have multiple contracts in play, then you're going to realize very quickly that you get to the point where you bump up against where your broker's telling you can't really buy any more of that or sell any more of that because you don't have the available margin. So it's good to know that the margin levels differ for each market, and they are malleable. They change through time. You'll notice that you'll get an announcement from time to time announcing different changes in margin. When something gets really volatile, the exchange will often up the margin requirements because they're left holding the bag if somebody owns a gigantic position and it goes against them so badly that they can't even fork over what's necessary to account for the leverage. The exchange will liquidate the position. And the exchange doesn't want to have to do that, so it wants you to know in advance so that you won't get blown completely out to a negative account balance by a relatively small move in a volatile market. So just be aware of that. And then also, of course, review the Symbology, the monthly expiries for each market you want to trade, and get this feeling that I'm talking about with being able to quickly interpolate ticks into risk per contract and therefore size of position. And that's different for every market. And just get a feeling for the charts. When you look at it, when you glance at it, be able to understand quickly how much size you should put on for that trade so that the risk that you're taking makes sense. Your stop is wide enough for you to not get knocked out on a noise move, and your size is enough for you to feel that the trade was worthwhile if it works and really took advantage of something that you understood about that market, and if it doesn't work, that you're not left in some kind of catastrophic loss situation. So just, keep it smaller than you think you need to. We'll go over that in just a second. And also, understand how to properly set stops, and we'll also go over that in just a second. Okay, so now we get to some of the lessons that I've learned over the years. First of all, as we've kind of had an emphasis on this, I think it's really important to have an emphasis on this, safety first. With the futures markets, with a really leveraged market, safety first. We can go back to the analogy I made at the beginning where you were talking about something like a power tool, right? If you shift from using a handsaw to using a power saw, you're going to need to take different precautions. There's no reason that the power saw is not inherently unsafe. If you have proper protocols, if you have proper discipline, and you take proper precautions, it's a perfectly safe tool to use. The futures market is exactly the same situation. Okay, so I touched on this just a second ago, but always use proper stops. To me, a proper stop is a native order, not a synthetic order. If you don't know what that means, look it up. But briefly, synthetic order is just an agreement between you and your broker. A native order is something that's actually programmed into the exchange order ladder on the exchange. Market orders are synthetic orders. Limit orders are native orders. And you can make a limit order function like a market order, by the way, if you put the limit order through the market. So that's a native market order. I would also say just always force of habit. Don't even think about it. Make your orders good till cancel and all hours, not regular trading hours. So outside of regular, usually most brokers will have this setting. You can say, I want this order to execute 24 hours a day and until I say don't execute. Otherwise, it's a day order and it will expire. When you get to midnight, that order's gone. And if it's not set explicitly to work 24 hours a day, when you get to whatever the end of the pit trading session is for that commodity or whatever it is, that order will expire. It's gone. So if you put it in and you've got a swing position, if you don't make a habit of this, you may forget at some point and you think you've got to stop in, but you don't. And then something major happens and that market takes off 5% and you wake up in the morning thinking, well, if anything went wrong, of course I'd be stopped out. And then you look and you have a really bad day. So always just set the stop right. Put it on the exchange, good till cancel, all hours. And a note about size here. This goes into the safety column. If you find yourself feeling emotional about small price movements, pan back, look at like a 60-minute chart, and if you can't even see what you're feeling emotional about, it doesn't even register on a larger time frame chart. The swings, so-called, that you are getting nervous about, then you're trading way too big. And you will definitely be unsuccessful as a trader, I can promise you, if you regularly experience that feeling. Small, meaningless movement makes you feel really uncomfortable and really uptight. That's right there. That's a big problem. And you will lose. You cannot think straight in that state. You need to be relaxed. You need to be strategic, tactful. You need to be totally willing to take advantage of minor noise swings that go against your trade. You need to be in a situation where you can maybe add to your position because it's handling things in a character that makes sense to you. And we're going to get into something I call market mode in just a second, and this conversation really applies. But when you've got the mode right of a market, you need to be able to stay with that trade. And the only way to do that is to trade in a size that makes sense. So it's really important. If you get that feeling, you're emotional about tiny swings, then you're in the wrong size. You need to be trading smaller. If that's one contract, some people have an account where if they were to trade one contract of silver right now, they would feel that all the time. They would realize how quickly $500 goes away and how quickly it gets added back. And that would make you feel really uncomfortable if you've got a very small account and your account represents all of the money that you have in the world. And what that means is silver's not one of the markets available to you to trade. Just forget about it. Don't worry about it. If you have to, trade maybe an options contract on SLV. That won't give you the same 24-hour protection, but, just move out of the futures contract if one contract makes you feel that way. And always have a larger time frame reason for entering any position. You don't just shoot from the hip. Don't just see a market. Suddenly you look over and this market has gone way too far in one direction. Don't just sit there trying to bang it back the other way just because of that. If you don't have a larger time frame reason, like it's gone too far against a big trend the opposite way that you believe in on a core conceptual and thematic basis, then fade that move, right? If it's gone up a long ways and you don't know anything else about it, don't fade that move. Don't do it. Don't get in the habit of just shooting from the hip like that. It will end up not working out for you. It's much better if you do that when you've already got this kind of idea about that market, and that move the other way actually is something you've been expecting as a possibility and hoping for as an opportunity. Then you're in a great position. Don't trade it too big. Take advantage of the move. Let it work in your favor, and then add to it when it really kind of shifts back into what you want to get aggressive with. But don't just shoot from the hip in a market that you don't really have a thesis on. Okay, really quickly, I think this is also important when you're coming up with conceiving your strategies in markets. What is a market, right? A market is not a physical system. A lot of traders approach markets as if it was just a physical system with laws of movement. And it's not. It's a big crowd of people, and all of them are trying to solve the same puzzle that you are, right? Or it's a poker game, another way to think about it. And another way to look at this, which I think is just an interesting little point I once kind of voiced in a conversation I was having with a friend of mine, a market is a machine for creating the least predictable path between 2 points. And that's because everybody's trying to predict how it's going to get from one place to another. And they're doing it on all different time frames. And what you get is something that's essentially impossible systematically to get in front of if the only thing you're doing is making bets placed on very short-term pattern reads and inputs. You'll just be the thing that's creating that least predictable path. Don't be a victim of it. And the way to not be a victim of it is to include larger time frames, to have nested time frames where you have a larger time frame pattern and an idea about that market, and then the smaller time frame action inside of it is in the context of that. And the two of them either do or do not make sense together, complementing each other. And when you start to get a feeling for putting different time frames together, you're going to find that you're a lot more productive with your capital. Okay, now next up, as I alluded to a few moments ago, there's a concept that's extremely important to me, and I just want to kind of express why that is the case and how it figures into another concept that's extremely important to me. And the first is market mode. And this is not an extremely technical idea, but it's something that I just came up with this term. I'm sure other people probably use something similar to mean basically the same thing. And it's sort of like a set of personalities that a particular market has. And so, for instance, let's take the gold market. All right, when gold is in a major uptrend, that's its mode. When gold is in that mode, it has an array of habits. It will do things in a particular way. There'll be a certain way that it deals with pit open, a certain way that it deals with pit close, a certain way that small time frame consolidations tend to play out, a certain type of news item that will cause it to spike, and a certain type of news item that will cause it to flush out. A certain way it will behave when everybody's bullish, and a certain way it will behave when everybody's bearish. But all of that is inside of the context of the way that gold generally behaves, its habits of action when it is in a major uptrend mode. And it's really important to develop a sense of gold in an uptrend mode as an object of reference, and understand and study historically how it behaves in those conditions, so that when you see it doing those things, it gives you more conviction that it is in a major uptrend, on the one hand, and on the other hand, when you know that it's in a major uptrend, you can see what it's doing and understand the sort of probability spectrum of outcomes, the outcome distribution of a particular situation or a news item or time of day reference or consolidation pattern or how it's probably going to handle certain support levels or resistance levels. And all this is different inside of that mode. And when it's in a major downtrend mode, like it is at the moment, it acts completely differently. Spikes to the upside are to be shorted pretty much in every situation. And when you see emotional movement upward, when gold is in a downtrend mode, just wait for that to peter out, get shorted, and really have a great time in a couple hours later. And that's just a very consistent mode of behavior. And so understanding the concept of mode, and why this is so important is because it plays into this other concept, the concept of conviction, which is the single most correlated concept with making lots of money trading futures. All right? Conviction is the key. That's your goal. Get to where you have conviction. So as you're devising your approach to a top-down macro focus in markets, whether you trade a lot intraday or whether you take large swing positions, either way, the most important concept to you in terms of being very successful, maximizing your profit potential on any given move, is the level of conviction you're able to get in a situation where you're right while also controlling for risks. That's the sort of holy grail here we're looking for. And for me, I've found getting really comfortable, doing the homework, doing the background work, so that I feel really comfortable with mode. When I've got clues coming at me that a particular mode is being exhibited in a particular market that I know well, and I start to see confirmation of that a couple days in a row, and how it's reacting to certain types of headlines gives me more and more of a sense. When gold was breaking down out of this pattern a few weeks ago, this was pretty much my experience of seeing all the things that I associate with gold in a major downtrend when it wasn't yet really manifestly in a major downtrend. It was moving into that mode, and it was very clear to me that that was happening. And that allowed me to have a tremendous amount of conviction, and so I was able to take a whole lot of size and put my risk in a reasonable place and make peace inside of myself with, okay, I can take that loss. If this doesn't work out, I'm willing to take that loss. It's worth it to try, and I can get myself sort of at home in the universe of not being right and just kind of make peace with that as the trade starts to progress, because then I can really let it run. So you get a lot of conviction, you get a good chunky size, you get risk placed in a way where you know the outcome is not going to be something that you're devastated about if it doesn't work out, and yet you feel that sense of conviction and that confidence as the trade is working out. It lets you really let it run. And that process, to me, I've identified it with doing the background work on a market so that you understand mode. And it just takes, studying markets, watching price action obsessively, and looking through historical data and really taking note as you see things, how it reflects a kind of habit or an underlying personality. Okay, now just some more general bits and pieces. I didn't really know how to classify it otherwise. Just key ideas. I would emphasize this: trade smaller than you want to. You'll feel how you want to trade. You want to pop up your size. You see a little something that makes you feel like kicking up your size a bit. Try to avoid that within reason until there's a moment where you just can't stand it, and you just know this whole thing is coming together, and it hits you on all levels. Every bit of your experience, every bit of you is just telling you this is now knowledge. This is no longer speculation. I can see what is happening. This is the time to really lever up. And it's great if you don't get into a situation where you lever up ahead of that and get shaken out a bunch of times, and then weaken your resolve to be able to really take advantage of a perfect setup. Try to keep it smaller until you've got that perfect setup, and then lever up and let it run. And the basic way to just the mantra internally is, keep it a little bit smaller than you want to until you just can't stand it. And I would say avoid strategies that emphasize scalping based only on short-term dynamics, and avoid strategies that are predicated on the idea of just making a small amount every day. Both of these kind of play into the same thing. When you see, you see the market, you see a chart on like a 5-minute chart of the S&P or a 1-minute chart of the S&P over the course of a day, and there's lots of little wiggles, and there's lots of little movements of a point or two. And a lot of people look at that and they just think, well, all I have to do is find a way to get one of those points, and I'll just put on 5 contracts, and that's going to make me about $60,000 a year right there. And what a great thing! I'll keep my day job, but I'll find a way to just systematically, without having to put that much effort into it, I'll get a point every day. And that's a very common way to approach futures markets, and I think it's a terrible way to approach it, and I think that it's very alluring and seductive. But what you have to realize is, going back to what we noted earlier, the market is not a physical system, and that's a physical system type idea, right? That's the idea where you see the principal aspects of something, and all you have to do is study those aspects of how it manifests itself, and then take advantage of its laws of movement. And what's important to understand is this thing is actually the upshot of lots of people doing that, right? So in other words, it's like trying to dance this dance on a bunch of bodies of people who are also trying to dance the same dance. And when you zoom out in terms of probabilities, you account for losses and you account for how much you're willing to risk on any given trade, the probabilities stack up a lot against you. And individual days don't matter. It doesn't matter that there's a sunrise and a sunset for the market. Big, large time frame narratives are what matters. Big trends, big shifts in money over the period of a year or several months or 2 years. Big bear markets and big bull markets and big consolidations. Those are the things that are important. That's the narrative. That's what defines the market that you're in. And inside of it, any given day is just a day inside of that. But what happens in that market and what should be the basis for your trading is understanding where that day's action sits in the context of that larger time frame narrative that's playing out, and where that market sits in the context of the larger financial universe when you look at it, relative to other major asset classes. That's the way to kind of, you want to mix together your short time frame pattern reads and your technical observations with your large thematic observations from top down of the sort of financial universe and what the bigger price movement narrative is for that market over the course of months or weeks. That's kind of where you want to keep yourself, rather than just trying to find a way to look at every day as a brand new playing field and see if you can manage to scalp out a point of it. I've done both. I started programming trading systems for the S&P futures and for the NASDAQ 100 futures about 14, 15 years ago, and I literally spent, I lived in St. Louis, I was bartending at the time, and I'd get back from the bar and just start programming, and program until past dawn, every day for almost maybe 2.5 years to 3 years, just constantly. I wrote programs that got to 2,000, 3,000 lines of code, just basically trying to find a way to come up with a system to be able to get that point or two. And it was really helpful that I did that, because that experience kind of infused in me a deep sort of intuitive understanding of market movement and the way the patterns play out, because years of my life spent hours every day of going through price patterns and trying to come up with some kind of magical mixture of things. But what I really learned after all of that is that it's better to just, it's good to learn the price pattern information, but it's not really a viable approach if you want to be very successful at this. You'll have periods that are great, but you will not be consistently successful, and you'll be subject to all kinds of psychological maladies in your trading. So, in my opinion, the best approach is to mix thematic observations about the marketplace with large time frame narratives about price movement, and inside of that, get better and better at understanding how small patterns give you hints or clues about what mode that market is in, and then understand where you've got good risk-reward relationships for taking advantage of where those large time frame narratives are going to be moving into really directional periods. And you don't have to make money every day. You really don't. I'm having an incredible year this year, and I've had 3 down months, small down months, but I've had plenty of periods where I'm barely trading, or I'm just looking at things and I just see no opportunity, and that's what I've learned to do. That's a really good quality in my trading, is to be able to see when the opportunity is really there, to really take advantage of it, and when it's not, to really not worry about it, and to let the larger narrative of what that market is doing, or what markets in general are doing, tell me when the opportunity is right. And just a general point, I've always found, unquestionably, one of the tenets that I hold most true, emotional markets are a whole lot easier to trade than unemotional markets. If you're somebody who reads price action, who gets a feeling for how patterns play out, people make bad decisions in emotional markets, and that's the margin of opportunity. If you are trading the small time frame patterns aggressively, that's where your margin of opportunity is. Wait for emotion. You can do it just by watching the VIX. When the VIX gets above 20 and holds, that's when you should be more aggressive, not less aggressive. That's when the easy money is there for the taking. And finally, respect the direction of trend and find a way to understand the nature of trending markets so that you can do this. You're not always caught by this reversion to the mean kind of issue. I mean, you're supposed to trade with the trend, but it's difficult in practice because you get that instinct. We all have that instinct. You want to just find that inevitable little bounce in something that's going down constantly and has gone down a long ways, because that bounce seems more and more inevitable with every tick, but that's not true. It is not true. It is a very bad instinct, and you need to find a way to kind of make a mockery of it inside of you and just shame it out of existence so you're not subject to it. Okay, much more important is to know that a lot of rookie traders are being controlled by that same instinct, and you can take advantage of them when they get stopped out. All right, so wait for people to wade into the river and put their hand up and try to push the water the other way, and then as you start to see them inevitably getting washed back in the direction of the current, you bet with the river, and that's the best way to trade. Period. It's just not a good idea to sit there trying to catch bottoms and downtrends and catch tops and uptrends. Wait for the mode to shift if you're going to do that, and if you really feel like you see a small uptrend inside of a larger downtrend, and you want to fade something that's moving, even though it's moving for a few days in the uptrend, and you want to find out, where's the turn going to take place, that's a reasonable, viable way to approach things. But I would advise you to really only put any kind of size into that sort of strategy after you see an emotional, spiky move in the direction of that trend that you're trying to fade. Wait for the quote-unquote puke of the people who are trying to fade it and then give up, and the people who have been betting with it, maybe getting sucked into too much position, and then finding that, so you get that puking moment in the direction of that trend, and then you get a pause, and then it just starts to kind of climb back the other way. And that's when to get involved. That's when to look for the fade, not before any sort of emotional movement. Okay, and one final point here in this section. This is a concept that I think tends to be important in terms of how you understand mode and how you understand patterns and how you understand sentiment. And it's when you're talking about trading different asset classes, it's the notion of symmetry and asymmetry in the market is important. And what I mean by that is the difference between longs and shorts, right? So for instance, the stock market, hugely asymmetric. Pretty much everybody's long. There's some short interest, but the majority of people in the world are happy when the stock market goes up. Think of it that way. In other words, generally speaking, fear type of movement is when stocks go down. Happy, hopeful type of movement is when stocks go up. So when you see a move on the charts and you're trying to figure out whether it's people being greedy or being scared, for the most part with stocks, you can say it's being scared if it's going down, it's being greedy if it's going up. Doesn't mean it's going to stop in either case, but that's the quality, that's the tone of that market. However, when you move over to a currency market, some people will then watch the euro and just unconsciously or subconsciously apply the same standards to it. And this is wrong, and you've got to catch yourself and not do that. So you're used to thinking of when stocks are getting hammered as that being about fear, right? But when you're dealing with the currency market, one currency is going down a lot, but the other one's going up a lot, right? So they're structurally symmetric, generally speaking. Long interest or the short interest. You can't say that as a standard structural characteristic, a particular currency market is mostly long or mostly short. You go through periods where everybody's betting against a particular currency. Right now I'm sure that that's getting to be the case for the euro, probably for the yen as well. A lot of people are starting to bet on the dollar. But, it's not a situation where downward movement in the euro is necessarily fear. It may be greed, just as we said. If lots of people are shorting the euro, they're buying the dollar, then downward movement in the euro becomes greed, right? So it differs based on the asset class. In commodity markets, no question, most of the input base level supplies are, fear on the upside. If crude oil goes up a lot, you can bet it's fear, right? There's some greed. There's long side speculators, especially over the last year or so, there's been a tremendous amount of long side speculation, but that doesn't matter. Still, the commercial traders are bigger, they're more important, and the fear is to the upside because they're dealing with organizations who have that as an input cost, and our society in general does. Most commodities probably fear to the upside. However, at tails, really, in commodities, I think it does shift. And when you get a trend going, when you start to get big tails going in, anytime you get that rapid sort of movement, it's probably fear because everybody tries to play reversion to the mean as a structural system in the commodities markets. But my point is, just be aware of it. Don't make the mistake of saying, you've got a kind of general way that you emotionally view moves in markets based on how the stock market is, because the stock market is very different from a lot of these other markets in terms of the symmetry or asymmetry between long and short interest. Final section here, and I'll try to kind of be brief with this so we can get to some Q&A. Let's tie it all together, elements of a setup. And I think this is important stuff when you're dealing with a leveraged market, to be kind of precise in how you construct ideas about how you're going to look to make money. For me, most important aspect of setup is a bit like Karl Popper said about in the philosophy of science about a hypothesis. A hypothesis is only really a valid hypothesis if you know exactly how it can be proven wrong, right? And to me, that's the same standard to put as a setup. A setup is only really a valid setup. It's not just about knowing that a market's going to go somewhere. I can see that, the dollar should be strong. But if I look to trade that premise, I've got to be able to construe my strategy in a manner where I have a certain amount of risk in play. I can concretely identify exactly what that risk is, quantify it perfectly, know that I'm going to be safe, and there's going to be an automatic process that makes sure I don't lose any more than that, and that losing that means that I'm satisfied with the idea that I'm wrong about that setup, right? So concretely understanding when you're wrong. Very important element of a setup. Okay, otherwise, I think you should think in terms of having a conceptual or thematic basis and a good sentiment situation, and also a short-term pattern trigger inside of a larger time frame pattern bias. That's the way that I look at things, generally speaking. It's not always perfectly like that, but ideally, this is the way you see things. You understand a market premise, and you know that the sentiment situation is not a situation where it's already crowded and everybody's looking for that exact same thing to happen, because that generally is going to be a bad time. And then you understand how it goes back to the market mode observations. You understand that you see clues that it's in the mode. You see a larger time frame pattern that shows you that that mode is playing out, and you see a short-term pattern that makes sense given all of those assumptions inside of that larger time frame basis, right? So the gold short that we're in now, go back to it again. I'll quickly go back over it because it kind of hits on these points and gives a good concrete example. Got heavily short in mid-August, added to it quite a bit toward later August. This is a longer time frame position than I normally hold, but it was definitely the proper thing to do in this situation. Concepts, gold short, it's an expression of disinflationary, deflationary bias, just with basically the Fed trying to hand off to the ECB in terms of liquidity, and that's just not going to be a valid process in my opinion. It's going to be difficult to achieve that in a way at least that most people are comfortable with, and certainly it's not going to be good for commodity prices and the gold market when you're coming into that second derivative decline in global liquidity on a serious basis without any inflation problem whatsoever. You got a dollar bull market, you got a commodity bear market. Both of those are really associated with weakness in gold. And one major misconception is that there's a lot of people who believe wrongly that gold prices are sustainably and predictably influenced by geopolitical tension, and it's just not really true. Traders think it is, and so they tend to displace the price of gold when there's some headlines about something like that, but it in no way changes on any sustained level the price of gold as a market. And so I don't really understand why anybody would look at the situation and decide that what they want to do is try to predict when there's going to be geopolitical tension and buy gold on that basis. Rather than, why not just wait until Putin drives a tank into something and they spike gold up $15 inside of a downtrend, and just go ahead and get short, set a stop, and make some money. Because that's the process that leads to an actual sustainable outcome. Because when that thing sucks a bunch of weekend longs in and shakes a bunch of short interest out, then when it rolls back over in the direction of trend, you not only get that rollover in those 15 points, but you probably get a whole lot more. The sentiment situation in gold at that time, when we entered the trade, great in terms of having by far and away a huge skew, probably influenced to some extent by the Russia-Ukraine situation, toward having a lot of spec long interest, and that's a week-to-week data point that you can see calculated by the CFTC. And again, a lot of that probably was because of this misconception, right? This misconception gave us a sentiment situation that was tremendously useful and accommodative to a short side strategy. And then, the larger pattern in the mode, if you just look back on the charts on the weekly chart over the last several years, gold has been in a lateral consolidation, which is generally speaking not the way you get a reversal of a major bear market. Usually you get the main leg, the primary leg down in a bear market, which we had in the spring and early summer of 2013. And that leads to, in most bear markets, you get that big leg down and then you get some kind of sideways consolidation and then you get a follow-through leg. Think of 2008 in equities, right? Lehman went under. We got the whole TARP situation, and we had the gigantic meltdown with AIG. Really that was a late September through October downward story and a big gigantic stock market crash. And then we got a moderate bounce and a sideways consolidation through November and into December. And then we got 3 months of new lows and that follow-through leg to the downside. That's a typical construction. Gold's doing the same thing right now. It had the big crash in 2013. It went into a 13-month-long sideways triangle. And now it's in that final leg of the bear market. And anecdotally, I think it's still unwinding a bubble because I still see a lot of spam email telling me how I can get rich in the next leg up in gold. And I still see commercials on television telling people how this is the safest place to put their retirement money. And, this is a relatively useless, soft, shiny metal that goes through a number of different phases and personalities over time. It's hardly generally just a great place to put your retirement money. It's tremendously volatile, it's occasionally illiquid, but people got a relationship with it over the course of the last bull market, and that relationship is gradually being unwound. Those assumptions and those ideas are gradually being reversed, and by the time the bear market is fully over, it'll be like any other one. At the end of it, everybody's going to hate gold, and nobody will understand why anybody was ever interested in it. And at that point, I think you want to buy a ton of physical gold, but you're just not there now. Okay, the large time frame pattern, there it is. There's the pattern we talked about. You can see the move down in 2012 in the fall and winter, and then the big crash in 2013. And then toward the end of June, the end of Q2 in 2013, we made that panic bottom. And since then, we've gone in a very tight specimen, Elliott Wave 4 kind of triangle pattern. You can see the A, B, C, D, E legs, and now we're rolling down. This is how the chart looked when I put the trade on. It's now almost to the bottom of that triangle. And in shorter time frame action, you can see about a month here. You can see the initial entry when we popped it up on the initial ISIS bombings and the escalation in Ukraine. Then we rolled it over once and then bounced back up again. And wherever that arrow is where we added significant size to the position on the morning that Putin actually was seen driving tanks into Ukraine toward the end of August. And we got a lot of headlines, and the bulls really tried to spike gold at that time. The short-term pattern on that day, on the 28th of August, these are spikes to the upside being met by very large sellers at about 5 points under the 1300 level. And as I was watching this, I thought there was utterly no question that bulls were coming in, people who are long gold and using extra capital to try to drive the headlines we were seeing out of Ukraine into a major squeeze so they can cascade orders out and get the thing above 1300 and start to get a different psychological tone to that market. But what they ran into was just giant distribution, just big sellers, big structural supply. Like, that's not a trick anybody did. That's the fact of that market, and that's why it's a bear market, is because there's a lot of gold to be sold, right? And so no matter how somebody tries to game it, they're going to run into the inevitable kind of gravity of the situation. And so what I did as a trader is just watch that morning, and I know that when gold is in the mode of being in a major downward trend, this is exactly how it reacts to things like headlines about geopolitical tension. It runs into that big, giant set of sellers well under the level that the bulls are clearly trying to break it through. It just can't go anywhere, and then gradually it starts to peter over. And that's where we added the size. Okay, guys, to wrap things up, here's how to follow me on briefing.com. I post under 2 different tickers on the site. The first is CHART, chart, which stands for ChartTrader. That's the ticker where I post my intraday commentary and my trading calls during the day. I also tend to post in the middle of the night if there's a major move going on in a market I've been following closely. The other ticker is ETFXX, and this is where you find my morning notes. The title of the column is actually the ETF Daily Notes, but it's really more of a general macro market column rather than something devoted to ETFs. I also post my big macro chart book about once a month under this ticker, and that's where I post my views on everything on a really big picture level. And finally, this service is fully interactive, and I want to make sure you guys understand that. One of the main features that you're paying for with the trader service, and I frankly don't think people take advantage of it enough, is this interactive aspect. You can email me anytime about anything you'd like. There's my email at the top, bmanning@briefing.com, or email the whole Briefing Trader team. Or you can also see where you can get to the Talk to Us feature, where you can click on this anytime during the day. That sends a message to the entire analyst team here at briefing.com. And we always like your feedback, and I'll get back to you if you ask me a question. I'll get back to you usually right away. So that's about it. Thanks for listening, and I'll see you on the next time around.